Smart business owners have more opportunity to dodge taxes than almost anyone else, but there's no reason you can't be one of them. I'm Grady Cool, CEO of Cool Wealth Management. Here are 5 of my favorite tax tips I use with clients to save them tens of thousands of dollars every year. One thing to keep in mind with all of these tips is to check irs.gov or with a tax professional before applying them every year. The most obvious place to start is qualified business income.
Yeah, so obvious.
In all seriousness, qualifying business owners can deduct 20% from their income on their taxes. In order to qualify, you must be a sole proprietorship, partnership, S corporation, or some estates or trusts may qualify. Mainly disqualifies C corporations, which tend to be saved for much larger companies, Microsoft, Apple, etc. Most income from business qualifies, whereas most investment income, passively coming in does not qualify. Check the link in the description for the exact details on what exactly qualifies with irs.gov. My favorite part about qualified business income, or QBI for short, is that it applies to your taxable income, not just your adjusted gross income. What this means is that it is a below-the-line deduction. So you can take a standard deduction or itemized deduction, and then after that, still apply the QBI deduction for even additional tax savings. While that may sound too good to be true, it kind of is. Unless there's an extension, 2025 will be the last year that QBI qualifies for being used. The second tax loophole comes from how you structure your business. If you set up your business as a S corporation, then you can avoid some self-employment taxes. Typically, when you run a business, you have to pay self-employment taxes, which includes things like Social Security and Medicare. Oh, how I just love paying that 15.3%. If you set up your business as an S corporation, you can separate parts of how you pay yourself. With part of your income, you have to pay yourself a reasonable salary per your industry and roughly how much you're working. The rest of your earnings can be distributions with you as the sole owner. You do have to pay self-employment taxes on the portion that you pay yourself as an employee, since again, you're an employee of the business, but on the distributions, you don't have to pay any self-employment taxes. One caveat that I will give is that on the salary portion, it does not qualify for qualified business income. As per always with taxes, there are some trade-offs. One other issue is that the distributions do not qualify for retirement plans. Retirement plans are one of the government's favorite ways to get people to save for retirement, but as a business owner, you have more advantages than most. Typically, with 401ks and SEP IRAs, you're limited to just the employee contributions, meaning significantly less as far as how much you can put in. As an employer, you can use the employer side of the plan, meaning you can put in significantly more. There are more rules about how much you need to give to employees than I can cover in this video. We would be here for a while. Assuming that they are active and participate in the plan. So I will be going on the assumption that you have no active employees in the plan for this video. For both a 401k and SEP IRA, the contribution limit per year with both the employee and employer side is $70,000 in the year 2025. One thing to keep in mind is that contributions on the employer side can only be up to 25% of total compensation, meaning you have to be making quite a bit to be able to max it out. But hey, some of you are some high rollers. While retirement plans do require you to wait to get your money out, if your biggest objective is total net worth and most tax savings over your lifetime, then they are a great option. This one is a little more fun. The travel deduction. The type of business that you have will change how applicable this will be, but it is applicable to a lot more situations than most people give credit. You do need a legitimate business reason to be visiting the place you are going, but there are a lot of legitimate business reasons if you get creative. If there's somewhere that you want to visit, then starting with seeing if you have a client or supplier there can be a good place to start. If not, if there is a convention or some sort of conference related to your field, that can be another option.
Hi, welcome to the National Plumbers Convention. We're going to show you exactly how to plumb toilets in the best possible way.
If none of those options work, then finding a new potential client is also an option. For example, if I want to visit New York, then since I'm able to do business anywhere in the country, I could start running ads specifically in New York, and then if 1 or 2 people get interested, I could set up some in-person meetings, and lo and behold, now I have a reason to go travel to New York. You could see why the type of business that you run ends up making a fairly big difference in this area. But the fun doesn't end there. We can actually write off a lot more than just the travel expenses themselves. Here are a list of expenses that potentially qualify from the IRS website. One thing to keep in mind with all of these travel deductions is that you're generally able to write off part of your expenses, but not necessarily all of them, as it is with most taxes. If you're willing to accept part of your compensation in benefits instead of just pure cash, then you're able to get a much larger pie. And you gotta love pie. If you're already on top of all of the tax tips, there are still some places that you can save on taxes. The health savings account is often misunderstood. People view it as a tax-efficient way to pay for medical expenses. That's true, don't get me wrong. However, it can also be a great long-term investing account. An HSA is generally tied to a health insurance plan and can only be contributed $4,300 in the year 2025 per year. If the money is used on non-medical expenses before you turn age 65, then there is the income taxes and a 20% penalty. After age 65, though, you only have to pay income taxes when you use it on something besides medical expenses. Thus, basically turns into an IRA, so you can spend the money on whatever you want once you are in retirement. It's not to say that using it on medical expenses is a bad idea. Honestly, it is probably best used for that and it's a great option. But not everybody needs to be spending $4,000 a year on medical expenses, so it's another option that can help save some extra money on taxes in the long run if you're looking for a few extra places to put money. Those are my 5 favorite tax tips, and please be aware of the trade-offs before applying any of them. If you have questions about your specific situation, please let me know down in the comment section below. And other than that, I hope you guys had a good one. Bye.